All right, you really threw us for a loop this time, getting ready to dive deep into fixed income securities.
Oh, yeah.
Yeah, we're looking at An Introduction to Fixed Income Securities by Kizzi Nkwocha.
Okay.
It's not exactly, a page turner,
Right.
but this stuff, I mean, this is the engine. This is how money moves.
It is.
And Nkwocha actually seems like they might be able to even make bond yields sound kind of interesting.
Yeah, it's not as dry as you think.
Yeah. So let's unpack it. When we say fixed income securities, what are we even talking about?
So at its most basic level, remember when you were a kid, you lent your friend $5, they said they'd pay you back with a little interest. Same basic concept.
Okay.
But instead of your buddy, it's governments or these big companies,
Right.
and they need cash, you get a set interest rate, and they pay you back when the loan matures, and that's the bond.
Okay, that makes sense. But why would I choose that over, why wouldn't I just put all my money in the stock market? Isn't that where the action's at?
Well, this is where the fixed part is really important. Stocks, that's your unpredictable friend.
Right.
Exciting one day, gone the next.
Right. Right.
Bonds are a little more reliable, especially like if you think about government-backed bonds. Those are the most stable.
Okay.
They offer that stability, predictable returns.
Yeah.
So if you're the kind of person who likes to sleep at night,
Yeah. I'm all about that good night's sleep.
that's, yeah.
So finding that balance, risk, reward. But are all bonds created equal?
No, not at all.
Okay.
Nkwocha breaks it down into a few different types. So you've got your government bonds. We talk about those safest bet. Then there's corporate bonds. Companies issue them. They come with different levels of risk, different potential rewards.
Okay.
He even gets into these high-yield bonds, which sound a lot, maybe more glamorous than they actually are.
Right. Right.
Remember those mortgage-backed securities, the MBSs from back in '08?
Oh, yeah.
Those are a whole other beast.
Okay.
And then you can't forget about municipal bonds.
Oh, right.
These are the ones that cities, states issue, usually for infrastructure projects.
Yeah.
It's kind of like investing in your own backyard. And the bonus is you might get a tax advantage. So,
Oh, interesting.
yeah,
It's like a buffet of bonds.
it is. It's a whole world,
But every investment, there's risk.
always.
What are some of the big things in the bond world people need to look out for?
Well, you're right. There's no such thing as a free lunch.
Right.
One of the big risks is interest rate risk.
Okay.
So imagine you buy a bond. It's got, let's say, a 4% interest rate.
Yep.
And
Yeah.
suddenly, interest rates jump up. Now they're at 5%.
Okay.
Your bond is stuck at that lower rate.
Right.
It's not as attractive. Could lose value.
Oh, wow. I hadn't even considered that.
Yeah, and Nkwocha actually gives an example. He says, imagine you bought this bond for $1,000, and now, because interest rates changed, it's worth less.
Ouch.
Yeah. And then there's the credit risk.
Okay.
Remember we were talking about bonds kind of like loans? Well, there's always a chance that whoever borrowed that money might not pay you back.
Oh, right, right.
That's a bigger concern with corporate bonds.
Yes.
Especially those high-yield kind of risky ones.
Right, right. Those high yield ones we talked about.
Exactly.
Okay, yeah. This is making me think about it differently. I gotta be honest, when I was looking at Nkwocha, he throws out some jargon.
Sure.
Yield curve, duration, convexity.
Yeah, it sounds very intimidating.
Do I need to be like a Wall Street, person to understand this?
You don't need a fancy degree.
Okay, good.
The yield curve, think of it like a mood ring,
Okay,
but for the economy.
okay,
It basically shows you what interest rates are expected to do.
okay.
It shows you, like, how bond yields relate to the length of the loan, right?
Right.
So usually, this curve slopes upward.
Okay,
So the longer you lend out your money, the higher the yield you get back.
okay.
But if the economy starts getting a little shaky, that curve can flatten out. It can even invert.
Oh, interesting.
And that's like the economy giving you the side eye.
Okay, so like a flat yield curve warning sign.
Exactly. A little bit of a warning sign.
What about duration, convexity?
So those sound like they're from a science fiction book,
Right.
but they're actually pretty cool.
Okay.
Duration is basically how much a bond's price will change when interest rates move.
Okay.
So think of it this way. A long duration bond, that's like a racehorse.
Okay.
Any little change, it's going to freak out.
Oh, okay.
Short duration, that's your workhorse. Steady, reliable.
So if you're worried about the interest rates going kind of crazy.
Short duration is probably your friend. Yeah.
Okay. And what about convexity?
So convexity, think of it as duration's smarter cousin.
Okay.
It's basically looking at how that price sensitivity itself will change when interest rates move.
Okay.
It's a little
It's
complicated.
a little more in the weeds on that one.
A little in the weeds, but it helps you kind of fine-tune how you're thinking about a bond's price will change.
Okay. And he briefly mentions CDs.
Oh, yeah. Certificates of deposit.
Certificates of deposit. Those are like the slow and steady tortoise of,
Yes,
of
absolutely.
investing?
You give the bank your money for a set period of time. They say, we'll give you this fixed interest rate.
Okay.
And it's usually a little better than what you're going to get in a savings account.
Okay.
So it's good for people who, they want a little return, not a lot of risk.
So it's knowing your timeline and knowing
Exactly.
how much risk you want. Can we go back to bond yields for a second?
Sure.
Because I feel like people hear
Big question.
they hear that phrase,
Yeah.
but what does it actually mean?
It's basically how much you're going to make on that bond, but specifically if you hold it all the way to maturity.
Okay.
So it includes all those little coupon payments you get along the way,
Okay.
any profit or loss you make if you sell it early, that kind of stuff.
So it's kind of a way to rate how the bond...
It's the performance metric, yeah.
Okay. What are some of the things that make that yield higher or lower?
It's all about risk and reward again.
Yeah.
So one of the biggest ones is, what are interest rates doing generally?
Okay.
When those go up, new bonds, they're more attractive.
Okay.
They have higher yields.
Right.
Your old bond, not so much.
Okay.
And then the other thing is how creditworthy is the issuer.
Right. Right.
Remember we were talking about credit ratings.
Yes.
High credit rating, less risk, lower yield.
Okay.
They don't have to pay you as much because you're like, it's pretty safe.
They're reliable.
Right.
Right.
Exactly.
Like a brand new sports car versus like a Honda Civic.
Exactly. You got it.
So the sports car might be more exciting, but you're going to pay a lot more for that.
Exactly.
What else?
So maturity date.
Okay.
Longer you lock your money up,
Okay.
the higher that yield tends to be.
Okay.
Again, risk, reward.
Right.
And then kind of just generally, what's the market doing?
Right.
If everybody wants that bond,
Okay.
price is going to go up, yield's going to go down.
Okay. Supply and demand.
Supply and demand, exactly.
Got it.
Yeah,
This is a lot.
it is a lot. And we're just getting started.
This has been an incredible start to our deep dive into the world of fixed income securities. So much more to unpack, but I think we need to take a quick break. We'll be back in a flash to explore the relationship between interest rates and bond prices, and we'll even unravel those mysteries of credit quality. Don't go anywhere. Welcome back to the deep dive. It's surprisingly complicated, this whole fixed income world.
Oh, yeah, there's a lot more to it than meets the eye.
Okay, so we talked about bond yields, but another thing I keep hearing is maturity dates. Can you remind us, what are those?
So the maturity date, that's the day the issuer, whether it's the government or a company, they have to pay back that principal amount to whoever invested in the bond.
Okay, so it's not just about getting your money back, it's how that date factors into the whole risk and return equation, right?
Absolutely. So longer term bonds, those are the ones with the maturity dates further out, right? They typically have higher yields, but there's more risk. Think about it. You're locking your money away for longer.
Right.
More time for things to change. Interest rates could go up. Inflation could eat away at your money.
Right, it's like a trade-off, right? Long-term, potentially bigger payout, but more risk along the way.
Exactly. And then shorter-term bonds, those are a little more flexible. Less exposure to those economic ups and downs we were talking about before.
So if I want my money to be a little more, I don't know, accessible.
More liquid. Yeah.
Yeah, exactly. So shorter term might be better. This reminds me of what we were talking about with the interest rates, how they can fluctuate. Do these maturity dates affect a bond's yield at all?
Absolutely. Because they play a huge role in something called yield to maturity. We'll call it YTM.
Right.
So that's basically the total return you can expect if you hold on to that bond all the way to its maturity date.
Okay.
And typically, like we were saying, the longer the maturity date, the higher that yield to maturity tends to be.
So it's like choosing between like a savings account where you get a little bit of interest versus like a CD where you lock it up but they give you a little more.
Exactly. Finding that balance.
This is making more sense. So it's not just about chasing the highest yield.
Nope.
You got to think about all these different pieces.
It's a puzzle.
Yeah, exactly. What about this credit quality thing? What is that, and why should I care?
So credit quality, think of it like checking someone's credit score before you lend them money, right?
Right.
But instead of a person, it's a company or a government.
Okay.
So it's really about how likely are they to actually make good on their promise to pay you back.
So it's like how trustworthy they are as a borrower.
Exactly. So strong credit quality, those are generally considered safer bets. There's more likely to pay you on time every time. Those are often called investment grade bonds.
So that's a good thing.
That's a good thing.
Investment grade.
And then on the other end of the spectrum, you've got those with weaker credit quality.
Yeah.
There's a higher chance they might not be able to make those payments.
Oh, right, right. Like those high-yield bonds we talked about?
Exactly. Higher potential rewards.
Right. Higher risk.
But much riskier.
Yeah. Like choosing between investing in, I don't know, a really solid blue chip company versus like a brand new startup that could be the next big thing, but also could completely fail.
100%.
Okay. So we've got these maturity dates, we've got credit quality. How does all this tie into interest rates and how they can affect bond prices? Because I know that's a thing.
So that relationship is huge. One of the most important things to understand about bonds.
Okay.
Think of it like this. Interest rates and bond prices, they're like on a seesaw.
Okay.
One goes up, the other goes down.
So if interest rates go up, bond prices go down and vice versa.
You got it.
Why vote?
Opportunity cost.
Okay.
So imagine you buy this bond, let's say it's got a 3% interest rate.
Star?
Suddenly, interest rates everywhere else, they jump up to 4%.
Okay.
Your bond's not looking so hot anymore.
Because I could be getting that 4% elsewhere.
Exactly. So to make it more attractive, the price of your bond is probably going to drop.
Oh, I see.
Make it a better deal for someone else to buy it.
Interesting. So it's all connected.
It's all connected. And that's why it's important, especially if you're thinking about selling a bond before it matures, you got to be mindful of what interest rates are doing.
Right, because if they've gone up since I bought the bond.
You might be selling it at a loss.
Got it. Okay, so how can someone who's not, a Wall Street wizard use this knowledge to their advantage?
Well, it's not about predicting the future perfectly,
Okay, good, because I'm not very good at that.
but it is about understanding what tends to move interest rates.
Yeah.
Things like inflation. How's the economy doing? What are central banks up to?
To do your research, basically.
Exactly. Stay informed. And then you can start to make some educated guesses about where things might be going.
So it's not just about looking at the numbers.
You're right.
You got to understand what those numbers are telling you about the bigger picture.
Exactly. And that's where knowing about things like duration and convexity can help.
Okay, yeah. So remind me, duration, that was basically how sensitive.
Like how much a bond's price will change when interest rates move.
Okay, got it.
So like a longer duration bond,
Yeah.
interest rates go up, that bond's price could really plummet.
Oh, so it's riskier.
Riskier in that sense, yeah. Shorter duration bonds are a little more stable.
So if you think interest rates are going to go kind of haywire.
You probably want those shorter duration bonds.
Got it, okay. And convexity, we talked about that.
So convexity is a little trickier.
Yeah.
It gets into how much that price sensitivity, how much it changes, when interest rates change.
So it's like, it's more nuanced.
Way more nuanced,
It's
yeah.
not just a straight line up or down.
Exactly. It's a curveball.
Okay, so this is helpful, but what makes the interest rates go up and down in the first place?
Okay, so that is the million-dollar question.
Yeah.
And unfortunately, there's no easy answer.
Okay.
It's not like one thing dictates it, right?
Right.
It's a whole bunch of factors. It's kind of like predicting the weather.
So we're talking economics, we're talking global events, we're talking
Psychology.
like what people are thinking, their mood.
100%.
Wow. Okay.
But let's break it down a little bit.
Right.
One of the big ones is inflation. When prices go up, that can push interest rates up.
And why is that?
Well, think of it like this. Central banks, they want to keep inflation under control.
Right.
One of their tools to do that is raising interest rates.
So if they raise interest rates, that makes it more expensive to borrow money.
Exactly. And if it's more expensive to borrow, people tend to borrow less,
Right.
they spend less, and that can help slow down the economy, hopefully bring those prices back under control.
So it's about finding that balance.
Always about balance, right?
Mhm. So if I'm like an investor and I'm trying to think about what interest rates are going to do, I got to keep an eye on inflation.
Definitely keep an eye on inflation. What's the Fed saying about it, right? Are they worried? Are they not worried?
It's like a clue.
It's a big clue, yeah.
What else can affect interest rates?
So how's the economy doing generally?
Okay.
If the economy is growing really fast, central banks might raise interest rates to keep things from overheating.
They don't want it to get too hot too fast.
Exactly. You can have too much of a good thing, right? But then on the flip side, if the economy is kind of sluggish,
Yeah.
central banks might lower interest rates
Yeah.
to try to encourage borrowing and spending to give things a little boost.
So it's about finding that sweet spot.
Exactly. The Goldilocks zone.
That's interesting. Are there other things?
Yeah. So we've got inflation. We've got how the economy's doing. Government policies can play a role too. Governments can influence interest rates through things like taxes, how much they're spending. And then there's also what's called monetary policy, which is basically what central banks do to control the amount of money sloshing around in the economy.
So politics plays a role in this too.
Politics always plays a role.
That's true. That's true in almost everything, I guess.
And, we can't forget about what's going on in the rest of the world either.
Right. Global economy, it all matters.
Exactly. So like a recession in Europe, for example, that could ripple through the global economy and end up impacting interest rates here in the U.S.
Wow. So we've got all these economic factors, but it sounds like you were saying earlier, human psychology plays a role too.
Oh, without a doubt.
How does that work?
Well, think about it. Investor confidence, right?
Okay.
How optimistic or pessimistic are people feeling? That can really move markets.
Right, because if everybody's feeling good.
They're going to be more likely to take risks. They might sell off their bonds and put their money in something with potentially higher returns. And then when everybody does that,
Yeah.
that can push interest rates down.
Oh, wow. So it's like a self-fulfilling prophecy almost.
A little bit, yeah. And then on the flip side, if everybody's freaking out, they might rush to the safety of bonds,
Oh, right.
which can actually cause interest rates to go down in the short term.
Interesting. So it's it's like a dance between what's actually happening in the economy and how people are feeling about it.
It's all intertwined. You can't separate the two.
Okay. This is a lot, but I think I'm starting to get it. We've got to talk about credit risk, though, because I know that can be a scary one for investors.
Yeah, it's one that keeps people up at night.
So remind us, what is credit risk?
It's basically the risk that the borrower just doesn't pay you back. They default on their debt.
So it's like that friend you lent money to, and you're like, I hope they're okay, but I also wouldn't mind getting that money back.
Exactly. You're like, are they good for it?
Exactly.
And just like with people, some borrowers, they're just riskier than others.
Okay, so what are some of the warning signs that, maybe this borrower is not so trustworthy?
One of the biggest ones is their financial health.
Oh.
Are they drowning in debt?
Okay.
Are they struggling to make a profit?
Okay, those sound like bad signs.
Yeah, those are red flags.
Yeah.
You got to look at their financial statements. Are they bleeding cash? That's never a good sign.
It's like looking at their bank account, basically.
Kind of, yeah.
Mm.
You want to make sure that they're actually going to have the money to pay you back when it's due.
Okay. So it's not just about, taking their word for it.
No, never just take their word for it.
Got it.
You got to do your own research.
What else?
It's also important to look beyond just the numbers sometimes and think about their industry. Are they operating in a really competitive market?
Okay.
Are there new technologies that might disrupt their business?
So, are they going to be around in a few years to even make those payments?
Exactly.
That's a good point.
It's not just about today, it's about tomorrow as well.
What about the economy as a whole? Does that affect credit risk?
Huge. A slowing economy, or even worse, a recession.
Yeah.
That can put a strain on even the most financially sound companies.
So a company that looks really good on paper
Right. They might seem fine.
could still be at risk if the economy takes a downturn.
Exactly.
What about things like, politics? We were talking about that earlier.
Yeah, so any kind of instability, whether it's political upheaval, new regulations, those can all impact a borrower's ability to repay their debt.
Okay, so it's a lot to consider.
It is a lot. It's like a whole web of factors.
Okay, so how do they protect themselves from this credit risk?
That is the million-dollar question, right?
Right.
And it all boils down to due diligence. You got to do your research.
Okay, but what does that actually look like?
So first and foremost, don't just rely on those bond yields.
Okay, so don't just chase the highest number.
Exactly. Higher yield usually means higher risk.
Okay.
You got to look under the hood, see what's really going on with that borrower.
Got it. So how do we do that?
Well, you can start with those credit ratings. Remember we were talking about those earlier.
Yeah, how trustworthy.
So those are basically like report cards for borrowers.
Okay.
They give you a sense of how likely a borrower is to default on their debt.
So is it as easy as just looking up the rating and then making a decision based on that?
I wish it were that easy.
Okay.
Those credit ratings, they're a good starting point.
Okay.
But it's important to remember they're just one piece of the puzzle.
Gotcha.
You should never rely on them solely.
So I got to go deeper.
100%. Read those financial statements.
Okay.
Do some industry research.
Okay.
See what the experts are saying, but don't just take their word for it either. Think for yourself.
So basically, be an informed investor.
Exactly.
Don't just blindly follow the crowd.
Exactly. The more you know, the better equipped you'll be to spot those red flags and make smart decisions.
This is really helpful. What about liquidity risk? You mentioned that before. What is that?
So liquidity risk. It's the risk that if you need to sell your bond quickly, you might not be able to.
Okay.
Or you might have to sell it for a much lower price than you want.
So it's not just about whether the bond's a good investment, it's whether you can actually get rid of it when you need to.
Exactly.
Yeah.
Exactly. It's like trying to sell that rare antique we were talking about versus something everybody wants.
Right, right. Okay, so what makes a bond more or less liquid?
So one of the big things is just how many people are buying and selling that bond.
Yeah.
If it's a really actively traded bond,
Okay.
tons of transactions happening all the time.
Yeah.
Generally, it's going to be easier to sell it quickly for a fair price.
Okay.
But if it's a more obscure bond,
Yeah.
not a lot of trading activity,
Right.
that's when you might run into trouble.
It's like trying to sell something on eBay that nobody's searching for.
Exactly. You might have to lower the price to get any bites.
Right.
Yeah.
Okay, that makes sense. So you got to think about liquidity too.
It's all part of the equation.
Okay. Any other risks we need to have on our radar?
So we've talked about credit risk, liquidity risk.
Yeah.
There's also reinvestment risk.
Okay. What's that?
So that's the risk that when you get those interest payments from your bond, you might not be able to reinvest them at the same rate, especially if interest rates have fallen.
Oh, so it's like I was earning a certain amount and now I have to reinvest it, but I can't get that same rate anymore.
Exactly. It's like taking a pay cut.
That doesn't sound good. So how do you deal with that?
Well, one of the best ways is diversification.
Right, not putting all your eggs in one basket.
Exactly. So instead of putting all your money into one bond, you spread it out among different bonds with different maturities.
Okay.
That way, even if interest rates fall, you're not stuck reinvesting everything at a lower rate.
That's a good strategy. So you're kind of hedging your bets a little bit.
Exactly. It's all about managing that risk.
Right.
And then another thing you can do is consider bonds with shorter maturities because those mature more quickly, you get your principal back sooner, and then you can decide what to do with it. You can reinvest it if rates are good, or you can do something else with it.
So you have more options.
More flexibility.
This is great. It seems like fixed income investing, it's really a balancing act.
It's a constant dance.
You got to think about all these different risks, all these different factors, and make the best decisions you can with the information you have.
You said it. You said it.
Okay, this has been a lot, but I feel like we're just getting to the really interesting part. We got to talk about these credit derivatives and Nkwocha mentions.
Oh, yeah. Those are fascinating.
They sound complicated, but also, like, really powerful.
They can be both, for sure.
Well, let's take a quick breather and come back for one last round where we can unpack credit derivatives and all the strategic opportunities they offer in the fixed income market. Stay with us. All right, diving back in for the final round of our fixed income deep dive. We've covered a ton of ground, but those credit derivatives have piqued my curiosity. They sound like something out of a spy movie.
They do have a certain, I don't know, a certain mystique about them.
Right.
But really, they're just contracts that help you manage credit risk more precisely.
Okay, so less like secret agent, more like
a tailored suit.
risk management.
Exactly.
Okay, I can work with that. So how do these things actually work? Paint a picture for me.
Let's say you bought a bond from a company and you're starting to have second thoughts about their ability to pay you back.
Okay, I've been there.
Maybe you saw a bad news report or their latest earnings call was a little shaky.
Right.
Now, you could sell the bond, but you might take a loss.
Yeah, nobody wants that.
So instead, you could use a credit derivative, like a credit default swap, a CDS.
Okay.
Basically, you're shifting that risk to someone else.
So it's like, I'm taking this risk, I'm handing it off to you, you deal with it.
Kinda, yeah. So with a CDS, you're basically making a deal with another investor, maybe a bank in another company, and you pay them a little fee, like an insurance premium. And they promise, if that bond goes belly up, they've got your back.
So I can sleep at night.
Exactly. A little more peace of mind. But here's the kicker. You can use these credit derivatives to speculate too.
Wait, so it's not just about managing risk. You're saying I can use these things to, like, make a bet on whether a company is going to succeed or fail.
You absolutely can. It's risky, but potentially very lucrative. So imagine you think a company is about to take a nosedive, right? Their finances are a mess. Maybe there's some bad press. You could buy a CDS on their debt, even if you don't own any of their bonds.
Interesting.
And if that company's credit tanks, like you predicted, the value of your CDS goes way up.
Oh, so you can make a profit even though the company's doing badly.
Exactly. Of course, if you're wrong,
Yeah.
you could lose big.
Sure. So high risk, high reward.
The name of the game sometimes.
Okay. This is making my head spin a little. Speaking of complicated financial things, what about those collateralized debt obligations? The CDOs.
Ah, CDOs.
I vaguely remember those from the 2008 crisis.
Yeah, they get a lot of attention back then.
What are they?
Think of it like, those variety packs of snacks.
Sure.
You got your chips, your cookies, your pretzels, all in one box.
Yeah, like a snack sampler.
Exactly. CDOs are kind of like that, but instead of snacks, it's different types of debt. Mortgages, car loans, credit card debt.
So it's like a debt buffet.
Exactly. And just like that snack pack, you've got different levels of risk, different potential returns, all bundled together. And they divide them up into these things called tranches.
Okay, so break that down for me. What's a tranche?
Imagine a layer cake.
Okay, I like cake.
The top layer, that's the senior tranche.
Yeah.
The safest, the lowest risk.
Okay.
They get paid first if anything happens. Then you've got the middle layers, a little riskier. And then at the bottom, you have what are called the equity tranches. Those are the riskiest, but they also have the potential for the biggest payouts.
Whew, so if I'm feeling lucky.
Bottom layers for you. But seriously, you got to understand what you're getting into with those CDOs. They can be incredibly complex.
Right, it's not just about picking a layer of cake and hoping for the best.
Exactly. Do your research, understand what's in that CDO, what are the risks of each tranche.
Okay, so CDOs, they're like a mixed bag of debt, different levels of risk. How do those connect back to the mortgage-backed securities we talked about earlier?
So an MBS is actually a specific type of CDO
Oh,
where all the underlying assets are mortgages.
gotcha. So it's like a mortgage-flavored CDO.
Exactly. And remember we were talking about how all those mortgages can be bundled together and sold off as securities?
Yeah.
Those securities often end up as part of a CDO.
And weren't those mortgage-backed CDOs part of what caused the 2008 crisis?
They definitely played a role,
Hmm.
especially the ones that were packed with subprime mortgages.
Right, right.
Because when those started failing, it created this ripple effect throughout the entire financial system.
It's a good reminder that even if you think you understand an investment, there can always be hidden risks.
Absolutely. You always have to be aware of the bigger picture.
This is all so fascinating, but I have to admit, I'm ready for something a little less stressful. What about those yield curve strategies you mentioned?
Yield curve strategies, now we're talking. It's like riding the waves, but instead of the ocean, it's the bond market.
Okay, I'm intrigued. So how does it work?
So remember that yield curve we talked about, how it shows the yields for bonds with different maturities.
Yeah, like a snapshot of interest rate.
Exactly. Well, those curves, they're always shifting
Okay.
based on what's happening in the economy, what investors are thinking.
Right.
And the idea is, if you can anticipate those shifts, you can position yourself to profit.
Give me an example.
So let's say you think the yield curve is about to steepen.
Okay, and remind me again, what does that mean?
That means long-term interest rates are going to rise faster than short-term rates, maybe because of inflation fears, maybe a booming economy.
Okay.
So you're anticipating this steepening. One strategy would be to buy up those longer-term bonds,
Okay.
because as those rates rise, those bonds become more valuable.
So you buy low, sell high, classic investing strategy.
In a nutshell, yeah. But of course, there's always risk.
Right, because you could be wrong about the yield curve.
Exactly. And if you need to sell those bonds before they mature, you might end up losing money. So it's all about timing, risk tolerance.
It's a lot to juggle.
It is, but that's what makes it interesting, right?
This has been an incredible journey. We started with the ABCs of bonds and ended up in the strategic trenches of yield curves and credit derivatives.
We've covered a lot of ground.
It's amazing how much depth there is to this world. Nkwocha really opened my eyes to the complexities and the opportunities of fixed income investing. But I think it's time for us to step back from the numbers and charts and leave our listeners with a final thought to ponder. If you could create your own fixed income security, what would it be? What would it fund? What kind of return would it offer? And who would be the ideal investor? That's all for this deep dive. Until next time, keep exploring and happy investing.